Hello and welcome to the Fight with Fitz. I'm Keith Fitz-Gerald, and we are starting off what could be a fantastic new week together. Earnings season is a knockin', and that's always a great place to be because it means we can get down to real results, real numbers, rather than lurching from headline to headline, as is almost always the case as the markets transition from one earnings season to the next, like it's been for the past few weeks. Anyway, I expect the next few days to be all about setting the tone, as I noted in last Sunday night's short, which you can watch elsewhere on the channel. And what a week it could be if the OpenAI AMD deal is any indication. I mean, holy smokes, what a thing to wake up to. So remember, in this department, investing is about focus, not noise. So plan, execute, and repeat. It's that simple. Repeat after me. Plan, execute, and repeat. Anyway, here's my playbook today, folks. Number one, the markets would love it if Washington stayed closed. Now, there's a lot of debate about whether the markets do better under the left or the right, but that's actually moot. The dirty little secret traders and smart investors alike know is that the markets often do best when the government is so discombobulated that it's actually out of the way. Now, don't get me wrong, the human cost of a shutdown stinks, and there's just no way of getting around that. People are getting hurt. My 2 cents is that the shutdown is tremendously irresponsible and that our politicians ought to be castigated for shenanigans like this. No pay, no perks, no pensions until there's a deal. But that's a story for another time. Speaking as an investor, my thinking with the Stuart Varney, the savvy Stuart Varney, this morning, who very kindly asked me for my take, is available elsewhere on the channel. It's an honor, as always, to be back. I also offered my 2 thoughts on 2 tech companies, one of which isn't traditionally thought of as tech, but I submit should be. So take a watch and think about it. Scared money never makes money, and Wall Street knows that much of America is scared. So they're doing what they always do, buying in anticipation of a fix when the shutdown is over. And what they know is counterintuitive, which is why you want to understand this. The retail investing public will start buying when the crisis is over. Well, 3 guesses as to who will be selling them shares at higher prices. Answer, yeah. Institutional traders and smart investors, along with every smart FI with Fitzer and OBA who is paying attention and buying now before the crisis is solved. Keith's investing tip in this department, always think like a shark, not a minnow. All right, number 2 today. This is the biggie, the big enchilada, if you will. AMD just cemented its path to $600, in my humble opinion. AMD has just gone vertical. It's up 34% as I record this after OpenAI announced plans to take as much as a 10% stake in the chip maker. The deal includes warrants for up to 160 million shares and a rollout of 6 gigawatts of AMD's Instinct AI GPUs over several years, starting with 1 million gigawatts in 2026. Now, get this, AMD is going to have a chance to take that stake, or excuse me, OpenAI is going to have a chance to take the stake in OpenAI. This stuff always gets complicated early in the morning. For as little as 1 cent per share if specific targets are hit, if the reporting I'm seeing in the early going is correct. Nothing like having a little incentive, huh? Both as an investor, both as AMD owner, and as an OpenAI company, provider, whatever you want to call it. Only thing I can think this morning is I probably don't own enough shares, so I'm going to have to do something about that. But shorter term, a swing trade to catch the quick money when it takes profits could be interesting. I don't know how you'd accomplish that, maybe with put options, butterflies, you could short the stock, I don't know. It's going to be tough timing, but quick money always makes a quick exit. So if you can replace that with long-term capital, that's a good thing. All right, number 3, Tesla is ready for a world breaker. So, this is amazing to me. The conjecture broke over a video over the weekend, because of a video over the weekend, about what's next for Tesla. And, whatever it is, it's going to be a world record breaker, particularly if it's the Roadster. Now, my take on this is super simple. Anybody who is foolish enough to bet against Musk and Tesla at this point probably bet against Apple back in the day, and for that matter, probably still is betting against Apple. Do not be foolish. I hear from investors all the time who just can't get past Musk himself for whatever reason. And that is okay. In fact, it's A-okay. Personally, I have a hard time getting past El Zucco of Meta. And I have for years, no matter how much money's on the table with Meta itself. So the point you want to think about as an investor is if you're going to make that kind of decision, or you're going to step aside, or you're going to step in, just be sure that you're comfortable with the all but certain fact that there's an entirely new generation of millionaires being created. And be sure to find another path, if not this one. All right, so OBAers, of course, understand the trade-off perfectly, and I will be here if you'd like to join them. They were early on in AMD and Tesla alike, and they are no doubt grinning ear to ear this morning like I am. Number 4 today, regional banks want a seat at the grown-ups table. What a concept! Fifth Third Bancorp just announced that it's going to buy Comerica for a $10.9 billion in an all-stock deal, right? Creating the ninth largest U.S. bank with roughly 280, 288, $290 billion in assets, if memory serves, based on what I read, once it closes earlier this year, or next year, I think it is. Comerica shares, of course, have popped more than 11% on the news, while Fifth Third slipped about 3%. That's typical knee-jerk reaction when the buyer reaches for the checkbook. Now, the real story here, and the one you want to focus on as an investor, is scale. This deal will give Fifth Third deeper roots in high-growth markets, more commercial lending, firepower, and stronger digital and payments footprint. Now, it's exactly the kind of foundation regional players need as banking regs loosen up. So, think about that one. It's interesting. Should you buy Fifth Third Bancorp or another bank? I prefer the other bank, but my point is, think about it. Scale is the issue here in the investable opportunity. And finally, number 5 today, can PayPal's prodigy reboot Verizon's dial-up growth? I'm asking because Verizon just named former PayPal CEO Dan Schulman as its new chief, replacing Hans Vestberg, who's been steering that ship since 2018 or so. Now, Schulman's got the chops. He took PayPal's revenue from $8 billion to $30 billion and added hundreds of millions of users along the way. Solid guy, solid plan, solid experience, no doubt. But I look at what's happening, and I wonder whether he can work the same magic in a business where growth has slowed to a crawl, and the competition is circling like sharks who smell blood in the water. Shares dropped roughly 2% on the news, which tells you that investors are cautious, and I think rightly so. Makes sense to me. Verizon is still digesting its $20 billion Frontier Communications deal, while T-Mobile and even SpaceX are busy redrawing the entire connectivity landscape. Meanwhile, people are holding on to older smartphones longer, waiting for AI-equipped devices like Apple's next-gen iPhone, which, by the way, is doing great. So the translation here as an investor is that data growth may stall before it reaccelerates. Now, I wish Schulman the best, but let's be honest, this feels more like a turnaround attempt than a transformation. It's just dominated by companies building the future of connectivity rather than trying to catch up to it. So I look at this as an investor with decades of experience in the marketplace, and I think to myself, the first law of the jungle is that bigger, stronger players survive. And Verizon just doesn't strike me as an apex predator anymore. Now, to be fair, right, I could be entirely wrong. I am not in the C-suite, so this is conjecture on my part. But over the years, I've learned the hard way to pay attention to the ache I get in my brain when something's off in a deal like this one. So anyway, take that with a grain of salt. Putskis, a bet the stock declines might be interesting to me. Not sure on the timing, but the investing tip here is super simple. Buy the best, ignore the rest, because the best are probably going to rise to the top. Anyway, bottom line today, get in before the crowd equals bigger. Getting in before the crowd equals bigger returns. Controlling risk ahead of time equals less stress. Building confidence equals holding strong when others panic. But wait and react? You and your money lose dang near every time, all the time. And frankly, I would hate to see that happen if I can help it. As always, let's make it a great day and get a strong start to the week. You got this, I promise. Thanks for watching, and I'll see you tomorrow. Cheers.